My name is Afifah Shahirah binti Azhar. I will present to you individual assignment on corporate finance.
What is capital? A company's capital structure is the combination of debt and equity it utilizes to fund its operations and expansions. What is debt? Debt is defined as borrowed money such loans or bonds that the company must pay back with interest. What is equity? Equity is defined as money acquired from shareholders through retained earnings or the issuance of common stock. Choosing a capital structure requires weighing the advantage and disadvantage, which is debt is frequently viewed as a less expensive financing option due to the tax-deductible nature of interest payments, which lowers the total cost of capital. Example, option 1, debt financing. Borrow the entire 1 million at an interest rate of 5% annually. Meanwhile, for option 2, equity financing. Raise 1 million by issuing new shares. The company will have to pay 50,000 in interest each year if it borrows the money. Companies and industry have different ideal capital structure, which means high debt levels are frequently used by businesses in stable sectors such as utilities, whose steady cash flows allow for regular interest payments. How to determine optimal capital structure? Debt signaling is when a corporation announces that it is taking on debt and usually interpreted as good news. The causes of debt, preferred stock and ordinary equity will start to increase if a company raises too much money in a given period of time. The mix of debt and equity that maximizes a company's market value while minimizing its weighted average cost of capital, WACC, is used to estimate the ideal capital structure. The present value of the company's future cash flows, as determined by the WACC, increases with a reduced cost of capital. Thus, determining the best capital structure that will yield the lowest WACC and the most company value shareholder wealth should be the main objective of any corporate finance department. Managers typically try to work within a range of values because it might be challenging to identify the capital structure. Besides that, they must consider the signals they give to the market through their financing choices. Next is factor effect capital structure. The capital structure is the appropriate arrangement that results that's allocating and allocating these funds while considering the firm's future operations and growth. The purpose of capital structure is to strategically raise finances for an organization's development. Here are 7 factors affecting capital structure decisions in business. First, business risk. Higher business risk makes it harder for companies to pay fixed debt obligations since it increases earning uncertainty. Second, companies' tax positions. The cost of debt can be considerably reduced through the tax shelter that interest payments offer. Third, financial flexibility. A business can respond to unexpected opportunities or difficulties without being limited by current financial responsibilities when it maintains financial flexibility. This flexibility is reduced by high debt levels since future borrowing capability is diminished. Fourth, growth rate. Businesses that are expanding quickly require large sums of money to finance their growth. Long-term growth is well aligned with equity financing, which offers permanent capital that is non-repayable through retained earnings or new stock issues. Although the demands to service debt might exceed cash generation, high debt levels in growing businesses can cause cash flow issues. Fifth, market conditions. A firm's financing choices can be greatly affected by the status of the financial markets. Firms may find it beneficial to issue equity at favorable prices in a bull market. Conversely, during interest rates are low, debt financing becomes cheaper, which encourages businesses to take out loans. 6. Asset structure. The type of assets a company has impacts how much it can borrow. Preserving as collateral, tangible assets minimize the risk for lenders and enable the company to get debt and reduce interest rates. Last point is profitability. Consistent earnings from profitable firms act as buffer for debt repayment. When deciding on a capital structure, earnings stability is quite important. Next, capital structure, as the name suggests, is the arrangement of cash from different sources to satisfy the business's long-term funding needs. Retained earnings, long-term loans, debentures, preferred share capitals, stock, and other long-term funding sources are all included. Decisions over capital structure also affect equity owners' risk and return. Okay, next point is a financial distress. A business or individual is unable to produce enough revenue or income to fulfill or pay its financial commitments. It is said to be a financial distress. High fees cost a significant amount of illiquid assets or revenues that are susceptible to downturns in the economy are typically the causes of this. The integration of tax effects. Analyzing and taking into consideration how taxes affect financial and commercial decisions is known as integration of tax effects. First, financial decisions. Because interest tax is deductible, taxes have an impact on the cost of capital, particularly debt as well as investment cash flows, such as depreciation tax shields. Second, business valuations. Tax have an impact on terminal value computations and decreased cash flows used in valuation techniques such as DCF. Third, capital structure. Although interest payments are tax shielded, debt financing is frequently chosen because it lowers the debts after tax costs. Personal and corporate taxes. Tax system utilize strategies like tax credit or dividend tax reductions to prevent double taxations of company profits and shareholder dividends. And last but not least, global taxation. Tax integration helps multinational corporations deal with cross-border problems like double taxations, agreements, and transfer pricings. Next, financial cost distress. What is that? Distress cost defines the monetary losses and unfavorable outcomes that a business faces when it encounters financial distress, which is a state in which it finds it difficult to fulfill its financial obligations, including paying off debts, operational costs, or other liabilities. They have two types of distress costs, which direct costs and indirect costs. What is direct costs? Direct costs means measurable out-of-pocket expenses that arise from the financial distress. Meanwhile, definition of indirect costs is more difficult to quantitate but can have significant impact on the company's value. There I have four causes of financial distress. First, high leverage. High leverage is using that excessively can put a company in financial distress, especially if cash flow isn't enough to cover principal and interest payments. Second is poor management, which means financial issues may arise from ineffective management techniques, bad decision making, or a lack of strategy directions. Third is market conditions, where a company may experience financial difficulties as a result of decreased revenue and profitability brought on by market shifts, industry-specific difficulties, or economic downturns. Last is operational problems like inefficient production, interrupted supply chains, or deteriorating product quality can all lead to financial troubles. Next is impact on company value. The impact is valuation decline is a company's market value frequently declines as a result of financial crisis because investors lost faith in the company and its capacity to make future earnings declines. Next impact is increased risk perceptions, which means lending to or investing in a business that is struggling financially is seen as a risk, which raises the cost of capital and lower valuations. The last impact is bankruptcy. As an extreme distress outcome is liquidations, which is a company may be put into liquidation if organization is not practical. In this case, assets may be sold to satisfy creditors, which frequently results in large losses for stakeholders, including shareholders. Next is agency cost of equity. Conflicts between a company's managers and shareholders' interests give rise to the agency cost of equity. As owners, shareholders want to get the most out of their investment, but managers who are in charge of managing the business may have a personal agendas that conflict with this purpose. These disputes result in expenses and inefficiencies that affect the company's overall worth. Monitoring costs such as employing auditors or putting governance mechanisms in place are incurred to keep an eye on management's activities and are included in agency costs of equity. For the sake of safeguarding managers and shareholders' positions and interests, managers may choose safer solutions, but shareholders may favor riskier tactics with the possibility of larger profits. Next, pecking order theory. The capital structure of a business is related to the pecking order theory, sometimes referred to as the pecking order model. In order to finance investment opportunities, managers prioritize using the company's retained earnings first, then debt, and finally equity financing according to the pecking order idea. The idea of disparate information gives rise to the pecking order theory. An imbalance in transaction power arises when one party has more better information than the other, a situation sometimes referred to as an asymmetric information or information failure. Compared to external users like creditors, debt holders, and investors, shareholders, managers and companies usually have access to greater information on the performance, prospects, risk, and outlook of the business. Internal financing, also known as retained earnings financings. Internal financing also the least expensive and the most practically option for funding a company. A larger return is expected when a business finance an investment opportunity through external financing, debt, or equity, because investors and creditors know less about the business than management do. The final point is signaling hypothesis, which is those pertaining to financing and dividend policy provide the market with insight about a company's prospects for the future. This theory is predicated on the notion that management usually possesses greater knowledge regarding the company's actual financial status and prospect. Manager can affect stock prices and investor views by communicating this confidential information to the market through their actions. Capital structure decisions are also subject to the signaling hypothesis, especially when deciding between debt and equity financing. Market conditions, management credibility, and the company's past performance are some of the variables that affect how successful signaling is in real life.
Thank you so much for watching and assalamualaikum.